Okay.
All right. So in the Maryland Realtor magazine, they talked about how forbearance is different than forgiveness because a lot of homeowners hearing the provisions under the CARE Act think that, oh, it's going to be forgiveness for the debt opposed to forbearance.
Mm-hmm.
And it is not forgiveness at all. It is very much forbearance. And with the forbearance, that's going to allow them to delay their payment. It says up to 6 months for 180 days, and then they can extend it up to another 180 days. So
Okay.
that's a whole year. So 6 months to a whole year that the homeowners don't have to make a payment. Okay. So that being said, it's very, very important that they understand what that means because that's going to come at a cost. At the end of either that 6 month or 360-day period, the homeowner has to choose what they want to do. If they want to reinstate the loan, they're going to have to make the full payment. So if they say by chance their mortgage is $2,000 a month for 6 months, at the end of the 6 months, if they want to bring their payment current or their loan, if they want to reinstate the loan, they have to bring it current. What does that mean? That means that they're going to have to pay $12,000 at the end of that 6 months in order to reinstate their loan the way that it was. If it's at the end of a year, then they're going to have to make that $24,000 payment in order to reinstate that loan and make it what it was. Now that's for reinstatement. There are other alternatives as well, so like a loan modification, which in my reading seems to be the best alternative because with the loan modification, what they're asking their lender to do is put the deficit, if you will, or the amount that they had forbeared onto the end of the loan so that they don't have to make that large lump sum payment. So for homeowners that do qualify to do that, that is going to be the best option because what that does is that allows for them to pick up their monthly payment without having to pay that $12,000 or $24,000 up front, but it'll be attached onto the rear of the payment.
Right. Okay.
Those are some considerations. Now, there are some obstacles with that because in my reading as well, it says that with lenders, and we're going to have Michael Cooper to talk on this topic as well, with the lenders, in order for a homeowner to qualify to get the loan modification, that with them having done the forbearance, it could potentially affect their ability to do the loan modification. Hey, Kurt? Because with the loan modification, they're going to have to show that they're able to sustain the mortgage. And depending on the lender, them having done a forbearance in the first place could be an indication that they have financial hardship. So it's a potential that could pose some issues to them being able to get through the modification process.
Okay.
That means that they're going to need to strap in for, the long haul with their lender. So if they need to go through various channels in order to get the loan modification approved, then that's something that they want to go through in order to make sure that that's done.
Okay. So I have, this is such a perfect topic for me. I don't know about anyone else, but this is the perfect topic for me. So the loan modification, is that the equivalent of deferment?
So that's not the equivalent of a deferment. What's happening now is their loan is being forbeared. So their payments are technically deferred, but there are two technical differences between the two. The forbearance means that all of their interest, the principal and interest and all of those things are still accruing. So at the end of that period, they're still going to owe all of it. It's just going to be a lump sum payment, but their payment is not due yet.
Okay.
So I spoke to a client this morning and she just applied for one and she didn't make her last two payments because she qualified for it after April. So for May and June, she doesn't have to worry about her first payment until September, it appears. Now, that being said, they can determine, they don't have to take the full 6-month period. They don't have to take the full 12-month period. It's based on what they feel their need is.
Right. Okay. But you're saying though that from what you see, the loan modification is the best way to go. However, if they have at this point missed payments, that can cause a little bit of an issue as far as the modification is concerned?
Yes. Now, when I say it seems to be the best alternative, it is the best alternative to what we're going to see, and this is where our discussion is going to we're going to spend the most time today. We're going to spend the most time talking about foreclosures and short sales. Now, the loan modification is one that's going to keep our clients out of foreclosure and out of having to do a short sale. You see what I mean? If they are able to do a reinstatement, if somehow they've come across a large, lump sum payment of cash, or if they've been saving over the last 6 months or the next 12 months in order to be able to make that payment, then that works. So there will be a small portion of people who are able to reinstate their loan exactly the way that it was. However, at the end of this period, whether it's 6 months or 12 months, they will need to make the loan current. What does that mean? That means that the lender is going to require a payment due from them at the end of this period. And if they don't make a payment to make it current, request some loan modification, or another thing is to do a refinance. If they don't do either of those things, then the lender will move into foreclosure. So it's important for us to read up on it. It's in the Realtor magazine. Kurt, we're talking about forbearance versus forgiveness, and we're talking about the climate that we're in with people receiving forbearance under the CARES Act because of COVID, and what implications those are going to bring into our market, and things we need to be prepared for, conversations we need to be able to have. And these things are referenced in the Realtor magazine for this month. It's page 22 through page 27. So just read through it a few times until it makes sense, and then we're going to have Cooper to get onto one of these calls and tell us from the lending side. We're just talking about from the real estate side what this is going to look like in our market and the conversations we need to be able to have with our clients.
Okay.
So that being said, the third alternative was refinance. So if they have equity in their home, then they may be able to refinance. Again, these guidelines are going to be based on whether or not they can prove that they have the financial capacity to pay the loan back. Now, because they've done the forbearance in the first place, that is going to provide somewhat of an obstacle that they have to overcome. And that's one of the things that the CARES Act doesn't articulate it as well. So I want to make sure that we are able to answer those questions and to help steer people, because you're going to have a lot of people that say, okay, well, what should I do? I can defer my payment and all of these things. And if they have to, then it's great. If they lost their job, then that's great, because that's going to buy them 180 days to 360 days, and that's great. If, on the other hand, they haven't lost their job and they could still make their mortgage payment, however, they just want to take advantage of this because it's on the table, then those are the people that you want to steer away from doing that.
Okay. I have a yes. So, and I guess maybe I need to schedule an appointment with you, because I have a specific situation, and it's that I have someone who right now is not doing because I asked her, is it a forbearance or, and she said, because she's made it clear to me that the missed mortgage payments are going to be attached to the end of the loan. Mm-hmm. And so, because I was telling her, I said, you have to be careful, because just because they are not requiring you to make a payment now, if in 6 months from now, all of that may become due at that time. Mm-hmm. So anyway, I think maybe I don't want to occupy all the time, and so maybe that's another conversation, so that I can have clear understanding.
Well, we can dive into that. That's not a problem. Let's walk through what we have today, and then we can dive into it at the end, okay?
Okay.
One thing that I will say is, based on the CARES Act, when a homeowner calls their lender, if they have a federally backed or federally insured loan, then they're not requesting documents in order to prove their financial hardship. So that's one of the easier means that's going to allow people to take advantage of it, okay? Now, that being said, that's for federally insured loans. And I won't give us the answer. Tell me what federally insured loans are, or which loans are federally insured.
So FHA loans? Mm-hmm. Is USDA loans?
With VA loans?
Oh, VA loans, yeah.
VA are guaranteed. So
right.
Yeah. Definitely. So we need to be able to have those conversations because that's what the insurance is for that they're paying for. When a buyer purchases with FHA, they're paying MIP or they're paying their, they're paying insurance every month in the event that they default, that lender's going to get paid. And a lot of people don't know that. A lot of people think that when a buyer defaults on a loan and the bank has to take the property to foreclosure, the bank loses money on the property, and that's just not the case. It's insured, so they get the payout from the insurance company for the amount of the loan. So that being said, that's one of the reasons why they're willing to allow those that have the federally insured loans to take advantage of this forbearance piece. Okay? But we want to have those realistic conversations because there are, like we were saying at first, there are people that have not necessarily lost their job. They're just looking at this as an opportunity that will allow them to save a few months or something like that, and it can be, but we just want to have that conversation with them so that they're thinking soberly about what the consequences are going to be at the end of the 6 months.
Right.
All right. Hey, Pam, welcome. And I'm going to give Pam a moment to warm up, but then I'm going to ask her some questions because she's skilled in this area. So I'm going to pick on her, although she just jumped on this call. All right. So that was with regards to the buyers having to either, I'm going to just reiterate it really quickly, Kurt. So at the end of this 180 days that the CARES Act is allowing for sellers to forbear their mortgage, they're going to have to either one, reinstate their loan by making a full payment, do some type of loan modification, and these are completely different alternatives. A loan modification is not a reinstatement. The loan modification, the bank is going to modify their loan if they qualify and put the difference in the amount that they didn't pay for the last 6 to 12 months on the rear of the loan. Because without doing that, what then happens is the buyer is going to have to pay, say by chance they missed, 6 months or a year's worth, if that's $2,000 a month, $24,000 for the next year. If it's the following year, they might give them 12 months to get caught up on that payment. So they might add the difference to their payment over a period of 12 months or so. Pam, can you hear us? She's having some computer issues. She's going to try to get back on. But these are the conversations that we want to be able to have. So what then happens is, at the end of all of this, you have a market that shifts a little bit in the climate. And what do I mean by that? I mean that you have a market that you're going to have more foreclosures and you're going to have more short sales. Because if we can imagine, if you tell someone that they don't have to pay their mortgage for the next 6 months and they don't have to provide you with any document, a lot of people are going to take advantage of it. If you tell people they don't have to pay their mortgage for the next 12 months, and they don't have to provide you with any financial hardship documents, a lot of people are going to take advantage of it. Some people rightfully so, because they're going to need to, and it's made available for them because some people have lost their jobs, and that's a great opportunity for them. But for the people who are able to pay their mortgage, we want to try to convince them to consider what that's going to mean, because if when it's time for them to reinstate their loan at the end of that 6 months period, if they're unable to walk through any of the processes that we just outlined, then what the bank does is the bank then starts the foreclosure proceeding. Okay? So once that happens, then the homeowner, then they have to do whatever they need to do if they want to move, if they want to stay, and we know how that goes. Then that's when they reach out to us, hey, I had a distressed property. We were able to see it because we can see when the foreclosure is filed. We get all that information on RPR. We get that information in our various systems so that we can see when the property is distressed and we can reach out to them. What does that mean? Also means also that we're going to have a larger short sale market. Some of these are going to be sales where the seller has equity and it won't have to be a short sale. That'll be a quick and easy sale, but then some of them are going to be underwater, and that's going to make it a short sale. So we just want to prepare ourselves to be ready to take on what the market is going to bring us later this fall or earlier in the winter. Does that make sense?
Mm-hmm.
Okay. Any questions so far? What are your guys' thoughts about this?
Like I said, this is good information for me just because I'm right now, speaking with someone who's trying to make a decision,
Mm-hmm.
you know, as to how they're going to move forward.
Mm-hmm.
Um, so, and again, like I said, I don't want to take up too much time.
Go ahead and tell me about the situation. Let's talk about it.
And okay, so what it is, unfortunately, in this season of Corona, there's been a split in the relationship in the marriage.
Mm-hmm.
And so, and I sent you the information regarding, remember the one I was asking you, to, if you could check out my comps and, kind of make sure that I was in the right.
Mm-hmm.
And so it is actually on that particular property. And so, what she has done is, so she's still in the property. What she has done is, she has stopped making her payments. The bank or her lender has, said to her that the payments that she has not made, I think this will be like the second month or maybe the third month, that will be, those payments will be attached onto the end of the loan. And the truth is that she does not necessarily have, the motivation to make the payments, because she's wanting to sometime next year sell the house.
Mm-hmm.
And so, and of course, then, so she's not, if for 12 months worth of payments, that's a lot. It's more than the 2,000, you know what I'm saying? And so is that, all of that obviously is going to become due, at the, when the sale of the property is. I wanted her, first of all, I did not know how long she would be able to defer, the payments, or so probably, um, I'm hearing, it seems even in her case, that a modification is still better, a better situation for her.
So it's going to depend, and there are a number of things that the lender's going to look at. So modification is a great choice versus her going into foreclosure because she can't bring it current. But the lender's going to look at all of the details, and that's when they're going to be able to determine which one she qualifies for. Because just choosing one over the other doesn't necessarily mean that it's going to be the best fit for her based on the structure of her loan, based on what's due, based on how much she makes and all those things. And oftentimes when you go through that process with a bank, it's very much like buying a house all over again. You got to provide all your financial documents. You got to do all of these different things, and they have to qualify under certain provisions for the various.
Right. I have my own personal concern for her.
Mm-hmm.
Just, because I know what her approach to, how it is that she's planning on, doing this.
Mm-hmm.
She is, in the household, the primary breadwinner. And so I'm not sure, in the end, when she gets ready, when she makes the decision, like, okay, I'm going to go ahead and sell, I'm not sure, or even when she gets to the place where, okay, I have to do something, can I, what can I do, that, they're necessarily, I think she's looking at it, or she's approaching it in a way that is more hoping that the lenders are more, empathetic,
Mm-hmm.
versus, what information are we able to gather and collect, and based on the information that we're able to gather and collect, this is what, your option is.
So I would wonder, does she qualify under the CARES? Her situation is a little bit different.
Does she qualify under the CARES?
Has she been impacted by COVID in any way?
Well, she says she has, based on the fact that there's now one person who is not in the home.
Okay.
One of the two people are no longer in the home. I'm not sure how that's going to work out though, because like I said, she is the primary breadwinner in the home.
So you know what? I want you to have an in-depth conversation with Cooper about it to see what he would advise her to do from a lender standpoint. Because
Okay.
I hear a couple things, and it may or may not fall under the guidelines for CARES. Now, we know that
Right.
they're not going to ask for any document, but I'm not sure if that's going to be in her best interest. What I will say is, from quite a bit of past experience with short sales and the like, it is not in the seller's best interest when they are able to make that mortgage payment. It's not in their best interest to just not make the mortgage payment.
Right.
Because when you're trying to get them approved to buy another home, it's not the short sale that hinders them as much as their missed payment. So when they complete a short sale or a foreclosure, unfortunately, it affects their credit. But what we found, and Cooper has just confirmed over and over again over the years, the missed payments affect their personal credit much more. It's much more detrimental than the short sale or than the foreclosure is.
Okay, so that's not even an issue for her.
Okay.
And the reason why I say that is because she owns another property that she's planning on, transitioning to.
Okay.
And so it's not even a matter of her. But I wonder too, to be quite honest with you, whether or not she qualifies for the CARES Act. I do wonder if she would, if in the end, once all of the required documentation is, and even because she's still employed. So I'm not sure.
I mean, I would.
Go ahead, Kurt.
Just to chime in, I have a conversation with her. If she does have another property that she's looking to, that she can essentially move to, like, why doesn't she just pull the trigger and move forward with just getting her current home just listed on the market and just sell it and get it off of her back? She doesn't have to worry about it. She can transition to, this other property, and then she's done, instead of, letting it, keep kicking the can down the road. Like,
Right. Okay.
Like, list
So,
it, get it sold.
Right. So now the one of the main reason being, so the second home is in College Park. It's near University of Maryland, and so she rents it out, and
Okay.
so it's actually being rented out to students, or just it's being. I think she said that there's one person in there that is not a student. However, so that's kind of one of the issues also.
Well, when would that so then you would see when's that lease going to be up? So
Right.
when's their last day? I mean, because she could still, list her property that she's in now, and then worst case, if it's 6 months or if they got a year left, she could also get she may not want to, but rent an apartment, month to month, and then as soon as those tenants are out, she just transitions, moves into her, into that home. But that one that's on her back, like, she's done with it. You don't have to worry about
Right.
that property, what you're going to do. Like, that's like an option. I'd ask how bad you want to go, because
Right.
we can get it listed now.
Right. And then also too, now just, because I know her very well. I know them very well. And so another kind of potential roadblock, and she has spoken with legal counsel, is the husband. And because she's wanted to before to sell the property, and he was not on board with it. And so especially now, because it was not a mutual split,
Mm.
You know, there may be, she feels there, and as I said, I do know them, you know, very well. I don't think, you know, God can do anything. But if we're just looking at, you know, just the person as the human being, that we know, it would not, they're not going to, it won't be an agreement of, yeah, okay, come on, let's just do it and, you know, move forward.
Mm-hmm. Yeah.
So that's a challenge too.
Did I hear you say they're a one-income household?
Pretty much.
Is he working?
Well, he is, gosh, I don't want to give out so much information. He is,
Yeah, I don't know.
Well, let me just say this. You don't have to give out the information, but an alternative that they do have, if they're both on the title to the property, they can do a refinance and refinance it out of both of their names into just his name. If she wants to get rid of the property, then that's
but he
something.
wouldn't be able to, he would not be able to refinance it only in his name.
Okay.
Yeah, he would not qualify to have it, you know, because I had mentioned that also, and she was, you know, yeah, because the mortgage is in her name, but the title is in both their names.
Okay. So then eventually they're just going to sell it and split the proceeds, cut their losses, and move on.
Right.
Yeah.
Okay.
I mean,
Well, that's her plan.
well, that's probably what's going to have to happen, especially if she's the only one making money. You know,
Absolutely.
like that's
Absolutely.
what, you know.
They'll just, absolutely, I know that, you know, that will be the end result. There's just going to be a great deal of resistance, you know, trying to get to that place.
Well, even with that resistance, she can still move forward. Like, you know, so that might even help move everything along as well. Where again, going back to the property that she owns, that she's going to essentially move into in College Park, she could, you know, essentially move out of her current home. You know what I mean? Kind of in the way, like dissolve herself of that particular property. Like, I'm out. Like, I'm going to live over here. I got an apartment. I'm waiting on these tenants to get out, and then I'm going to transition in here. And now whatever's going to happen with this house, it's going to happen. But you know what I mean? Like, that kind of can even make it where just more or less stressful on her, where she can kind of get on, you know, start that healing process and like not have to worry about that home that they're in. Because if he's already gone, you know what I mean? Like, you've left. Like, I'm not sitting in here. Like, you know what I mean?
Right. And so now, and as it is right now, as it stands right now, there is equity in the home, you know? And so, you know, for her to, or for them to get as much equity as possible, you know, and that's what I had said to her, you know, but again, you know, it's not going to be an,
We'll walk through the process, don't worry. Even if we have to do it hand in hand, sometimes it's like that, especially when you have those situations that are, you know, they're not our favorite, but they need people to be there for them too. So it is good. We'll walk through the process with them.
Because eventually they are going to sell.
Right, absolutely.
Whether it's this month or a year from now.
Whether it's court ordered or whether it's consensual.
Right,
yeah.
Right.
And you need to be the agent representing.
That's right.
Well, and I feel confident that I would be, you know. I mean, we have such a history. I mean, the two of us and the couples, there has been, you know, some, you know, tension, not with her, but with him. And then there was a coming back together, and then we know a lot of the details, you know, of the house and the relationship. I'm the godmother to their oldest child. You know, my husband and I are the godmother to their oldest child. And so it's a little bit hard in that sense, you know.
Yeah.
But, I'm confident that I'll, be able to represent them in the sale of the house.
Sure.
Well, it's good that they have that type of trust in you because they know that you're going to be impartial and do what's in the best interest.
But he doesn't necessarily have that trust. I'm trying to, and we have, to know all the parties involved, then you'd understand.
Mhm.
I mean, to know the parties involved, then you'd understand.
That's one of the things that's going to be crucial in the beginning of that sales process for you to convey to him that although you guys have that relationship, professionally, you have to be impartial because professionally, both of them are your clients and you owe them the same fiduciary.
Absolutely.
So you have to do what is best on both of their parts, and you might have to reiterate that a number of times so that so that he can kind of separate the personal from the professional and think, oh, well, Anita might be a little bit closer to her. Well, hey, now my license is hanging on this.
Right.
I can't, be partial and only do what's in the best interest of one party because both of you are my client.
Right.
All communication that you send to one, you send to both. Every question that you pose to one, you pose to both. All updates and everything, you make sure that they are both on the same page at the same time.
Okay.
Find is when you do it that way, then both people feel equally represented. But if you call and you just have a conversation with one of them or a conversation with the other, even if it's a conversation that benefits them both, the other person can start to distrust, oh, well, I'm not sure, if that's something that's going to benefit me. And it's unfortunate when we have these situations where couples are going through a divorce, but it's our responsibility to be sensitive to those things. All text messages, all emails, all phone calls, all voicemails, they have to include both parties, period.
Okay.
All updates throughout the transaction. And again, in the beginning, throughout the transaction, the middle, end, just iterate and reiterate that I'm bound by our code of ethics to represent you both equally in this transaction. You are both the principal, and I owe you both the same fiduciary.
Okay.
And at the end of the day too, right? Because the court it's not like you're in there selling the house and she's going to get more money because
right. Absolutely.
Like it's and from your standpoint, you want to get as much money out of that sale as you can because that essentially benefits you, and then have a smooth transaction, So,
Mm-hmm.
Right.
Or you could also look at Porterhouse. If it's that bad, then you could be like, look, I'll step back. I have, other team members. I have people in the brokerage. You still, get your commission. It's your client. You might give somebody else, a percentage.
Mm-hmm.
But now you can kind of step back. They might then feel even more comfortable, especially him, because now he's dealing with somebody who has no clue who they are, what their deal is. And that might even be an easier, way to get to get to the finish line,
Right. Okay.
That's an excellent option because, again, the first thing you want to do is win his trust. And like Curtis said, if he doesn't feel comfortable, you have a team. You have a whole brokerage full of agents. As long as you make sure that you keep your business in-house and you're helping them, whether it's through referral to somebody else or directly, then you still help them with that transaction.
Mm-hmm.
Right. Okay.
Because the last thing that you would want is for those feelings of maybe impartiality to go or partiality to go unchecked. And then you have him going off finding another realtor while she's working with you. You know what I mean? Right. So just nip it in the bud up front and do what you need to do so that they both feel comfortable.
Okay.
Mm-hmm.
I got it.
All right. So I'm going to touch back on this information from the CARES Act. What I want us to do is I want us to get ahead of this. This is going to be conversation within the next few months that's going to be very broadly disseminated. And I want for us to be well educated about it, and I want us to educate our sphere of influence. So when you look through this information, I want you to pull out pieces. Even if you do maybe 2 or 3 different emails, I want us to create campaigns and send them out to our clients proactively so that they have this information. so that they know what this information means and how it's going to affect them. You want for them to hear it from you because you are their real estate resource. You know what I mean? You don't want them to have to go fumbling around and figure it out and all that good stuff. The more information we provide to them, that's going to be helpful to them in their financial situation, the more likely they are to come to you and say, hey, Anissa, hey, Darlene, Curtis, I need you to list my property. You know, I saw the article that you sent out about, you know, forbearance versus forgiveness, and I need some insight on this. You know what I mean? So that's just another way of winning their trust. All right. Is there anybody that has questions about, I guess, the end of that process when it comes to either the preventing the foreclosure with a quick sale or a short sale? Is there anybody that has a question about that? Well, good. We know we have short sale service, and that works on the short sales and all that good stuff.
Yes.
Insight, short sale. You had a short sale that you walked through.
Yeah.
Tell us what you learned from walking through that short sale process. Maybe some nuggets that you can pass along.
The short sale that I was dealing with was very the owner lived in New York. The property was in Owings Mills, Maryland. She had kind of like a squatter in there. It was under contract. They did the final walkthrough, and the guy never moved anything out. There was a leak above the kitchen. The ceiling fell through. So they bailed, had another person under contract. That fell through, and then finally had a cash buyer. The good thing was that the cash buyer was an investor, so he couldn't get the commission. So I got the full commission for the short sale. So I guess that was my reward for dealing with everything. I'd say the main thing with the short sale is to really express to the owner that, you know, one, we don't want it to go to foreclosure. The short sale is going to essentially stop the bank from moving forward to the foreclosure. Even when you're under contract, it stops everything. So that's when we hand everything off essentially to our short sale specialists, and then they're negotiating between the banks, the first mortgage, second mortgage, you know, whoever is attached to that property. Now, in that instance, when that deal fell through, in order to keep the foreclosure, you know, police or the folks that want to come in and foreclose on the property at bay, you had to then immediately put it back on the market. So when the bank sees it as like an active listing, they're going to stop they're not going to mess with the foreclosure, because they would rather that property be sold, because they don't want to end up having it foreclosed and then they sitting there holding this townhouse or holding this house. So the diligence of like, okay, the contract fell through, immediately turn it back on as an active listing under a short sale, so that you can market it, it's out there, you know, and then eventually you get somebody, you know, hopefully wants to come in, write an offer, take the offer, give it back to the short sale negotiators, and then you kind of sit back and they just go back and forth with the banks. But I would say the main thing, especially like what we're talking about, moving the next 3 months, you know, 6 months, as these properties, you know, people might be coming up where, hey, you know, I haven't been able to pay my mortgage, or I haven't been able to do this. Is it going to foreclose? Like, absolutely not. Like, we can stop that we can hemorrhage that wound right now. Like, you know, how much do you owe? You do the 11%. So whatever they owe, you add 11% to that. If they can't sell it for that, then you know it's going to be a short sale. Get it listed, get it out there, and just kind of explaining that, you know, you're not, like with this particular client, she waited. I mean, it was like,
yeah,
it was there at the, you know, it was right there at the end. And she just happened to like reach out to me as really a last result or, last like, hey, can you help me? And then, sign off on a listing agreement, put it out there as a short sale, had the photos taken, and just put it out there on the market. And it stopped it. I mean, she still had, because she was so in arrears with her HOA association, she had to work something out with them to finally release it. And I believe she's still making payments on that lump amount that, that she owed to the HOA. But I was able to get her, it's done. She has the property now for back. That's her responsibility to make those payments. But it was, it was stressful. Well, it's just different, the short sale. I didn't mind it, though. I mean, it's just another transaction. The nice thing is once you're under contract, the short sale specialists we have,
Right.
they're the ones really working. You're just going back and forth. You just sitting back waiting on the banks to be in agreement. And then it's like, then it becomes ratified. Then it's truly a ratified contract. And now that 30-day
Right.
countdown happens. But I'll take short sale all day. Like it's just another transaction. It just sounds short sale and foreclosure, and it's like, oh, I can't let it foreclose. Like it won't. But we have to get it on the market. Like let's get it listed. As soon as we get it listed, it stops the foreclosure process.
I'm going to chime in on something that Curtis said, because that is hugely important. When we're helping our clients to stop the foreclosure, time is of the essence. So when you have that conversation with them initially, you want to let them know, I need all of these documents. I need it in 48 hours, and I need to be able to get a ratified contract over to your lender. And if we can tell them we need to get it over to their lender at least 30 days before that sale date, that's going to give us the highest probability of stopping that foreclosure. Because what we find is some people, they give you the information in advance and your short sale goes along and there's no issue. Then you have some people that call and say, I have a sale date of Saturday. What can you do to help me? And you look and you say, today is Thursday. You know what I mean? All things are possible, but it's a little bit less probable when they don't give you the time. So just urge and stress the sellers to just regard the time so that you can stop that foreclosure, so that you can complete the short sale. Or if they have equity in it, then it's a quick sale for them, and they don't have to worry about the process. And another thing that we do to kind of encourage them is, you guys know that for all of our clients, we ask for moving expenses for them. So they're not guaranteed, but we ask for them on every transaction, and most of the time we're able to get sometimes $3,000, sometimes $5,000. It used to be the HAPA program that gave up to $20,000, but now we get like $3,000 to $5,000 per seller for the short sale, and this is how we use it. We say, okay, well, we can work to get you, $3,000 to $5,000 for your move if you're able to get me these documents within the next 48 hours, so that I can send all of this over. Does that make sense?
Right.
Mm-hmm.
So the HAFA, what is this called? The three? Because I haven't done a short sale in a long time.
So HAFA no longer exists.
Right.
So under Obama's administration, what he did was the debt forgiveness. So the debt from a foreclosure and a short sale was automatically forgiven, and then also the homeowners were given up to $20,000 in moving expenses. So that was under the Obama administration. So when Trump's administration came in, they just did away with it. They said we're not automatically doing that. So now the homeowners, when they sell, they're still responsible for the taxes on the difference, because they call it capital gains. And now we'll no longer honor the $20,000 in half, but the banks will still give a full portion. And that's
Right.
why we're grateful that short sale service, and they're going to ask whether the seller asks for it or not. Because for a bank, it's worth it for them to pay this out to move than for them to short sale or foreclose on the property and have a seller squatting in it for 2 years and they can't get them out.
Right.
So it's in their best interest to pay them for those relocation expenses.
Right. So is that how they refer it, as relocation expenses?
Yes.
Okay. Okay.
it's very important though that relocation expense, like they have to, there needs to be furniture there. Like there, like it has to look like this, that they are going to relocate.
Right.
They got to get a van and they got to pack stuff up. So with that situation that I was in, when they first went out, that guy had all his stuff. There was, furniture on every floor. So then eventually the seller had to come down. They got into, basically they had to kick this guy out. Then they made him pack everything, right?
Mm.
So at first she was going to get around $3,000 to $5,000. So she was even going to profit on the short sale. But by the time we actually got to the final, the final contract, the house was empty. So when they went back in for that final appraisal,
Wow.
they were like, oh, well, there's no relocation because there's nothing in here to relocate. And I was just like, but at the end of the day, I was like, who cares? Like, you're getting it sold.
Right.
But you have to kind of look like
you really are, you need help to relocate.
So keep a bed, or don't fully just, have it empty. They ain't going to give you no relocation money.
Right.
There you go. I'm so glad you said that, Curtis, because another thing is the utilities. So you don't want, for the sellers, you want to make sure that they don't change their mailing address just yet, and they don't turn the utilities off. Because the same thing goes, if the bank is sending the mail to that house and it's bouncing back because the seller no longer lives there, then as far as the bank is concerned, the seller has already moved. Or if the utilities are off and finds out, then the seller has already moved. So just like Curtis is saying, the bank needs to be able to prove that they're actually giving them these thousands of dollars for relocation expenses because they need it for moving out of the house. So they need to actually have something to move out of the house and have things that show that they do still live in the house, like the current mailing address and utilities and furniture and all that good stuff.
Okay.
That was very good. Thank you. Is my audio delayed?
What's that?
Yes, it is.
What does it sound like? Let me see.
Sound muffly.
Oh my goodness.
Slow crackle.
Okay. Is this better?
Yes.
Oh yeah.
Okay, good. Can you guys hear me clearly now?
Oh yeah.
Yeah.
It might have been too because so your 301-613 number wasn't muted.
Yeah. And I learned this trick from the time we had the office.
We can't hear you though unless you have the phone up to your ear.
Yeah.
I can join on my computer.
But we can't hear you now.
You guys hear me now?
You're too far away.
You got to put the phone up to your ear or put it on speaker.
Okay. Can you hear me now?
Yeah.
Yes.
Yeah.
Okay. So I learned this trick at that time. Now I have two lines of defense. I'm on my computer and my phone because if my audio on my computer goes on the fritz, then you can hear me on the phone.
Okay. Yeah.
Yeah. I had to be prepared. I didn't want that to happen again. But I noticed, I could see in your faces you were waiting for my voice to come across. I'm like, is my audio going crazy again?
Yeah.
Just a little bit. Just a little.
Well, I appreciate it. So that's good. This is a very important topic, guys. Let's go back and let's do some reading and rereading so that we can be prepared and so that we can be ahead of the 8 ball when this comes out, okay? Let's share this information with our clients. Let's share it with our sphere of influence so that you guys are the resource, because this is going to be a very real climate in the real estate market. And the good thing about it is that means more listings. Mm-hmm. Okay, that means that there's going to be a ton of listings that are going to be available in the market, but you want to make sure that you are the early bird that gets the worm.
Mm-hmm.
All right. Any questions or comments or concerns?
No.
All right.
Now, I have a question on another subject matter.
Okay.
It's a totally different subject matter.
Okay, it's 1:30, so if anybody has to go, I'm going to let you go and we can continue to talk about that subject matter. I'm going to stay on. You can go ahead and.
Okay, so my question for you is, I had the question posed to me during a listing agreement, right? I mean, a listing agreement, a listing presentation
Okay.
about security of contents of a home, you know, and if something is taken out of the home during a maybe a visit, you know, a showing, what you know, what steps can the seller take as far as, you know, recovery and or reimbursement?
So that's a good question, and that's one of those questions that is covered in our listing agreement. So as it pertains to you, were you looking to get the listing?
Right. So I'll just tell you this. It was my husband who asked, right?
Okay.
Right. But, and I went through a full, you know why? I went through the full presentation with him. And the reason being is because we feel like this is the season where we're getting ready to do make a transition. Okay.
Okay.
And so we're in the process of preparing our home, you know, so that we can go ahead and put it on the market. And I had been given, you know, like I'm just talking to him and giving him, you know, information just here and there and telling him whatever. And it just came to me. I said, you know what? I probably should just do, you know, a listing presentation with him because he's a very analytical person, you know, and so maybe this can answer a lot of the questions that he has. And so, so I did, and that was a question that came out. And I thought that I had read something in the listing agreement. I hadn't gone back. We just did this last night, and so I hadn't gone back and tried to find out. I said, well, you know what? I'm not, you know, I explained to him how we do what we need to do to safeguard as much as possible, you know, as far as we're only bringing qualified buyers into the property. You know, we encourage you as the seller to not just leave valuables out, you know. But I did say to him, I said, you know, I said, that's something I'm going to have to look at and get back with you.
So the technical answer is it is a buyer's responsibility. And what does that mean? That means that the listing agent is safeguarded. Our contract says that we're not responsible for any damage or anything to the property or anything, any personal possessions in the listing. And the other buyer's agent, they are not responsible in that sense. However, if they bring a buyer in and they're aware that the buyer has stolen something, that will be a complaint to the board on that agent's license, and that buyer will be personally responsible. So not the agent, but the buyer. If the agent is unaware, then that's something totally different. Now, a lot of people will sometimes ask that question, but I can honestly say in all of the transactions we've done, we've never had it happen before.
Well, that was my, that was, I was like, well, you know, I've not experienced that, you know.
Yeah, we've never had it happen before.
Right. And I also explained to him that, you know, you can't even necessarily, it would be a little bit, I think, difficult for you to even be able to pin it on one specific buyer, because perhaps you've been gone from the property all day and 4 or 5, you know, potential buyers have come through with their agents. So how can you determine, you know, which one, you know, did that?
Did it, yeah.
Yeah. So based on our contract, when we read our buying agency and our residential contract, and we read our listing contract, both of them give indemnifications to the agent.
Right.
It also says that if the buyer were to damage anything, then the buyer is responsible. So what it does is it protects us, but then that buyer is liable. Now, it's different, however, if something happens based on negligence from the buyer's
Right.
agent.
Right.
So that's when, the guarantee fund, the board, and all those different things will come into play, and the seller can make a grievance against the agent in that regard. But whatever buyer it was, one of the things that I'll say is we use the showing time system because it helps to keep everybody accountable. You know
Right.
exactly who's showing, when they're showing, and you have a full record of each day. So, if you come home at 4, something was there at 3, you had a showing, at 3:30, the likelihood of which agent was there, and they will know what client they had.
Right.
So
Right.
there will be a broker-to-broker conversation to see if we can, find a resolution, if they can bring it back or whatever it was that happened. But it's the buyer that would be at fault unless there's negligence on the agent's part.
Right. Okay. And I did mention that part too, about,
Good.
not just anyone is able to just come, even an agent. I mean, and that's outlined in the presentation itself. If they don't have an appointment, then
That's right.
they need an appointment. And how we use showing time and how we're able to, track the activity based on the report that we get from the showing time.
And our process is a lot more secure than people understand because of the fact that in order for us to work with a buyer, that buyer needs to be pre-approved. That means that buyer has sat down, they've given their social security number, their birthday, their address, name, ID, all of their personal information to a lender, which you're privy to. You have access in the event that you need it. You have the pre-approval, you possibly have a copy of their ID and all of these things. This is not just like a fly-by-night person that can come in and steal something and kind of go under the radar. You have all of their information. So
Right.
That's probably why we literally have never had it to happen before, because there's too much exposure. All of the buyer's personal business when you take them into the house. You
Okay.
know who they are, you know where they are, you know how to find them.
Right.
The lender has their social security number. So in that case, there's probably too much exposure for buyers to try something like that.
Right.
I'm not saying that it can't happen, but I've never heard of it happening, and we've never seen it happen in our career.
Right. Okay. That part I did not. Okay, that's good information too to be able to pass on.
Mm-hmm. Yep.
'Cause
So that just helps to increase the accountability.
Right. Okay. Okay. Okay.
All right.
Well,
Sound
thank
good?
you. Yes.
Mhm.
You are very, very welcome. Kurt, did you have anything to add before we end?
No. No.
Okay. All right. You guys are the best. Let's go back and send this information out. All right?
Good.
All right. You take care. Have a good weekend, you guys.
All right.
You do the same. And Anissa, if you want to call back and talk through that other transaction in detail, then you can, okay?
Absolutely. Thank you so much.
All right, cool. Have a great day.
Bye.
You too. Bye-bye.
Bye-bye.